All right, welcome back. In the last video, I kind of left us with this idea that if we have excess returns, if we're earning economic profits, making a lot of money on the assets employed, that will attract competition. That will signal to competitors they should at least look into entering the market. In a couple of lectures, we'll talk about how hard it is to get into the market. We'll talk about competitive advantage and barriers to entry. But I want to talk a couple more lectures on what are your competitors thinking when they look at your financial returns. So that's what today's lecture is. All right, we've talked about this. This is the DCF challenge. We're trying to find the value of these annual cash flows. Now, I've shown 10 years, but in reality, it's forever. But think of it kind of a 10-year forecast. How do we value that? And our primary tool is a DCF. But as I talked about in the last two lectures, the real challenge is modeling growth. All right, so if we split the cash flows into two streams, a steady state, what I often call is the blue line, it's a blue area. I often call no growth steady state or steady state no growth value. And then green value. Green is growth. We've got to go and value that growth. And this lecture series is called Value of Growth. So we're headed towards valuing that green, but I really want to nail down the blue a bit more. So what I'm going to do in this video and a couple more videos is come back to what is that blue? What are your financial results signaling to your competitors? After we get that, I think, pretty well established, we'll then go into a series of lectures on competitive advantage, how a company would keep competitors at bay, how you would keep the your competitors out of your business. They potentially want to come and steal your customers, your revenue, ultimately your profits. So we'll talk about that in competitive advantage. But what I want to do is kind of just talk a little bit about this blue area. Now, modeling this area is easy, as I showed in the last lecture, because if you make the assumption that the cash flows are going to last forever, we can use a perpetuity valuation formula, which is fairly simple. You can think of it as multiplying that annual cash flow by a multiple, or capitalizing that annual cash flow by an implied return. Same exercise. All right, modeling this is easy, but it is based on the assumption that those cash flows will last a long time. And I know some people find that, I always get pushed back and they say, well, I'm not sure I feel comfortable forecasting those cash flows well into the future, and therefore I may not be comfortable with the assumption that they're going to be steady state, and which means I can't really use that perpetuity valuation formula. However, and I've said this before, I'll say it a lot, every time you use a multiple, PE multiple, EBITDA multiple, very common in private equity investment banking, or even a price to sales ratio, you're effectively forecasting cash flows or sales or something, EBITDA, well into the future. Anytime you use a multiple, you're effectively capitalizing those cash flows or that EBITDA. And the moment you capitalize it, you're assuming that those cash flows will last well into the future, way beyond a 5-year explicit, well into 20, 25 years. So even though this might sound like a bold assumption, or maybe an assumption that's too hard to be comfortable with, the fact is we make that assumption every day. And in this model that I am building up for you, we're being very explicit in that assumption, whereas when you use a PE multiple or an EBITDA multiple, it's there. That assumption is there, but it's rarely talked about. All right. Now, if we have a good handle on that, what I call earnings power, but that steady state cash flow that's going to last for a while, we then can capitalize it. And that is your definition of earnings power value. All right, that's our base camp. That's a good place to start. Now, the question we've been dealing with in the last video, this video, and the next couple of videos will be, what if competitive pressures enter the market, competitors enter the market, and those competitive pressures drive those profits lower? Now, all of a sudden, the assumption, now we really are challenging the assumption of whether or not those cash flows are going to be steady state and last for a while. So we really do have to think about, even at the earnings power value, this is long before we get to the challenge of valuing growth. We really have to think about what are those competitive pressures. There's a kind of a mirrored question. What I'm going to deal with in the next couple of videos is what your competitors are thinking. And then once that's settled, or at least I've reviewed that material, we'll then flip it and say, what are the competitive advantages? What are the barriers that keep competitors at bay? So today we're really going to talk about what competitors are thinking, and then we'll talk about what companies have done or can do to keep competitors away from their profits. Okay, great. All right, so I start this with, will a positive NOPAT attract competition? And the answer is, it seems like yes. The world's very competitive, more competitive today than maybe ever. Companies are always looking for new opportunities to enter new products, new markets, new geographies. And so the intuition is that if you had a positive NOPAT, positive cash flow, positive earnings, wouldn't that attract competitors? And so we have to test that. And that's why I'm saying, well, let's think about it from a competitor's perspective. Maybe they will, maybe they won't. All right, so what is your potential competitor thinking? So the CEO of the company puts out a challenge to her business development or her operations people and said, we have some excess capital. We want to invest that capital. They have $100 million to invest in a big project, and she wants potential ideas. Now, the company's in the beverage business already, so she has said, bring me some ideas that are in beverage. I don't want outside that area. If we exhaust beverage, maybe we'll expand to adjacent markets. But for the moment, I want ideas in the beverage industry if possible. All right, so down at the bottom, all opportunities require $100 million investment. This is a big investment. And the cost of capital in all cases is 10%, which means the projects have an annual capital charge of $10 million. The project is not going to earn the $10 million. It's not going to earn enough to cover its cost of capital. It's not a good economic decision. All right. So the day of presentation, she's told there are 3 investment opportunities. 1, enter the craft beer market. 2, enter the energy drink market. And 3, enter the hard kombucha market. Now, in each case, she can only do one of the investments because she has $100 million. Company has $100 million in capital to invest, and all 3 will require it. So you can't do more than one. All right. So first one up is craft beer. All right. Let's see what we've got. All right. So craft beer. Here's the investment opportunity. The invested capital will be $100 million. That will be the same for every investment opportunity. All right. Cost of capital is 10%. That will be the same for every investment opportunity. So your capital charge is $100 million times 10%, which equals $10 million. All right, there's your formula in the upper right-hand corner. All right, so we just know for each opportunity, that's going to be your hurdle. The hurdle is that the investment at scale is going to have to be able to earn at least $10 million. Otherwise, it doesn't make economic sense for the company to enter the business. Now, remember, we put this together. The frame we're thinking about is, what is your competitor thinking? We're going to elaborate on that in future videos, but that's where I want to focus for the moment. All right. So the team gets up and says, we believe at scale, the business will generate $10 million in NOPAT, which has then an implied return of 10%. Return on capital will be 10%. That's the 10 million earned each year divided by the 100 million invested. Okay, great. Now, if you think about this, excess returns in percentages is 0. The cost of capital is 10%. The implied return is 10%. So 10% minus 10% is obviously 0. And the other way to think about it is you're going to earn 10 million in NOPAT, but your capital charge is 10 million. So excess return in dollars is also 0. So whether you're thinking about this from a return perspective or an incremental value add in terms of cash flow, they end up with essentially the same answer. All right. Is she going to be interested in making the investment? The answer is unlikely. I don't say no, but unlikely. And the question is why? And mostly because the implied return on capital in the investment opportunity is equal to the cost of capital. So there's no juice here at all. It's sort of uninteresting. Now, To make this investment worse is the invested capital is almost a guarantee. The estimate on how much invested capital you have to put forward is probably a good number. The 10 million in NOPAT is an estimate. So because it's so close to the cost of capital, so close to the capital charge, it's unlikely they will make the investment. All right, let's go to number 2, energy drink market. All right, exactly the same. $100 million investment, 10% cost of capital. Your capital charge is 10 million, 100 million times 10%. That's the hurdle. All right, the forecast is that at scale, it's a competitive market. The forecast is NOPAT, annual NOPAT of 8 million, which implies a return on capital of 8%. That's 8 million earned each year divided by the 100 million invested. So an 8% return on invested capital, that's the forecast for the business or the investment. All right, now, if we look at excess returns in percentages, it's the investment opportunity is actually underwater. We can see the excess return is minus 2%. That's because the implied return, ROIC, of the investment is 8%, whereas the cost of capital is 10%. All right, so that doesn't look very interesting. And then if we look at the excess return in dollars, we see that it's implied that the investment at scale will earn $8 million, but our capital charge each year is $10 million. So we actually generate negative $2 million in economic value. All right, you make the investment? No. And why not? Because the cost of capital, the return on capital is below the cost of capital. All right, so we've now had 2 cases, and I hope you're starting to see a pattern from what a competitor is going to think. The return on capital, implied return on capital in the first investment was 10% against a cost of capital of 10%, and probably don't make that investment. The second one, the implied return on capital, ROIC, is 8% against a cost of capital charge of 10%. So you don't make the investment. All right. Finally, hard kombucha. Interesting business, still kind of a growth market. It's not fully penetrated. Identical. The first step is identical to the other 2 cases. We invest $100 million. We have a capital charge of 10%. Our capital charge is $10 million. So 100 million in investment times our cost of capital. That's the same in all 3 cases. All right. Now the team gets up and says, we actually think this investment opportunity is interesting. We think at scale, we could earn NOPAT of $25 million a year. So that's an implied return on capital of 25%, 25 million in annual income, cash flow against a $100 million investment. All right, excess return in percentages is 15%. That's the 25% implied return on capital minus your cost of capital. So that's nice. And then your excess return in dollars is $15 million. That's the 25 million implied income from the investment at scale minus your capital charge of $10 million. All right. Now, are they going to make this investment? Yes, of course. Why? Because the implied return on capital from the investment is greater than the cost of capital. All right, so we've seen 3 investment opportunities. They all have the same investment, all have the same capital charge, 3 different forecasts for their success, 3 different economic implications, and 3 different investment decisions, I think. All right, so if you look at the 3, we put them into a simple table, we can see that craft beer is kind of a wash, unlikely to make the investment. Energy drink is underwater. It creates negative economic value, so make the investment probably no. And then hard kombucha, as it's been presented, it looks very interesting. Both the cash generated against the capital charge or the implied return against the cost of capital all look very attractive. All right, so we can put this into a nice visual. Craft beer, you can see, is cash flow neutral between NOPAT and the capital charge. Energy drink is actually negative because blue, NOPAT, is less than the capital charge. It's a cash flow shortfall. Whereas hard kombucha looks very interesting, right? Green, we have significantly greater return in terms of dollars or returns versus the capital charge. Same chart looking at percentages. You see exactly the same. Craft beer is a return neutral investment opportunity. The energy drink is a return shortfall opportunity because of the return. And then hard kombucha is potential excess returns, which makes it really the interesting investment. So if you look at this chart, this one or the one before, it's pretty obvious what investment the CEO, is going to be interested in. All right, so it all comes down to cost of capital versus the implied return, and do you invest? And I think that's really the key insight that I want to take away in this segment. So will a positive NOPAT attract competition? No. It's excess returns that attract competition, not just a positive NOPAT, because the investment has to be made by the competitor. So I'm hoping we're starting to see what this looks like from a competitor's perspective. If the business is earning high returns, that's going to attract competitive interest, if not ultimately competitors. If the returns are potentially negative or even neutral, most likely that will dissuade competitors from trying to enter the market, being interested in entering the market. All right, so it's not excess returns. I'm sorry, wow, it's not positive NOPAT. It's excess returns that attract competitors. All right, thank you very much.